The Consumer Bankers Association is pleased to welcome you to today's webinar, The Struggle for LTV, presented by Curinos. My name is Isabella, and it is my pleasure to facilitate today's event. Thank you for joining. Please note we are recording and all participant lines are muted. If you have any trouble, please email conferences@consumerbankers.com or send a message in the Q&A box. This presentation will last up to 60 minutes and will include question and answer opportunities. You may submit a question at any time by entering the questions into the Q&A box on the bottom of your screen. As a reminder, the views expressed in this webinar are those of the presenters and do not represent the views of CBA or its members. It is now my pleasure to introduce our speakers, Sarah Welch, Managing Director, Marketing Solutions, Hank Israel, Managing Director, Prospecting Analytics and Innovation, and Olivia Liu, Managing Director, Marketing and Product Advisory Practice. Sarah, Hank, and Olivia, welcome.
Thank you, Isabella. And hi, everyone. Thank you for joining us today and spending the next hour with us. As the title indicated, the struggle for lifetime value. And how do we get there? So today what we'll go through are actually four kind of big, if you will, big ideas, big sections. The first half of it will be very much focused on what's happening out there today. Why are we struggling for a lifetime value? And we'll end with really more around what are things that we can do? What can we take away from this that is actionable and that we can take away to our teams in order to actually strive for customer lifetime value? So with that, Olivia here, I'm going to be facilitating today between Sarah and Hank and facilitate this conversation. Be very active because at the end of throughout this entire presentation, we have 4 embedded polls. So we will be watching to see whether or not you're, five embedded polls to see whether or not you're paying attention. So let's get started. So the first question we'll set up is really around the notion of acquiring accounts versus acquiring future value. Do we need to, as banks, as FIs, really need to rethink what the definition of account is and whether or not targeting accounts as a notion needs to evolve? So with that, this particular question, I'm going to hand it over to Hank.
Super, thank you. Obviously, as we look at the landscape of deposit account acquisition and customer acquisition, which is primarily coming in through checking accounts over the last 10 or 15 years, we've seen a dramatic decrease in the percentage of consumers seeking new relationships. The economics of acquisition have shifted dramatically. There's more competitors. There's fewer people in motion. And there's additional channels to reach those customers, so it's more costly to get there. What we're observing is similar to what happened to credit card in the late 80s and early 90s, where it nationalized and a lot of new competitors came into the market to try to target in new ways, creating adverse selection. So I think that what we're observing in the deposit market is that's beginning to come to bear. Organizations are getting better at understanding the customers that they can attract organically versus on a marginal basis, e.g. adding marketing to acquire more customers. Number two is that we're coming to the capability to also engage with customers in more direct channels than we were in the past. In the late 80s and 90s, mass media was still a primary form of acquisition. As we're able to target that and create experiences for consumers, we're now able to talk more on a one-to-one basis. So if we look at the 20 million customers, which is roughly 7% of the population that's churning in any given year, they break out additionally in terms of value. If I look at a bulk of those customers, they're customers that are living paycheck to paycheck. And while we can support those sustainably, the economics of acquisition in that space are beginning to become pressured with reduction in fee income, also with new competitors in the form of fintechs and other online providers that are reducing the value proposition that banks had. As we move up the spectrum to stable mass market, Henry's, and affluent, we observe that these customers have deep enough wallets that they can sustain the economics of acquisition, meaning the cost of acquisition is less than what the future value of those customers are, but there are fewer of them, is 40% of the population. And if I really look at affluent and above, we're down to 10 or 15% of the population, which drives a bulk of the value that you can acquire. One of the challenges that we're really seeing is that some organizations are facing adverse selection. They're going out with generalized messages which attract the whole base, but some other organizations are beginning to target for value. And we'll kind of talk about that as we go through today. But for sure, you get what you fish for. And if you're not asking for value, you're not going to get it. If we go to the next page, to illustrate this point, not only is it challenging that there's only 7% of the population churning, but probably only 2/3 of the people that are churning are actually looking for a primary relationship as we move forward. Roughly 30 or 40% of those populations are looking for secondary accounts or kicking the tires. So we have far fewer consumers that are actually looking for that full value exchange that we used to enjoy in financial services. More exciting is that there's literally billions of dollars chasing millions of customers in financial services, creating an average CPA of 520 as we go through. This number kind of moves around a little bit, and we'll kind of talk around some of the metrics that are driving that as we move through the presentation. But again, millions or billions of dollars chasing millions of customers, only 15 or 20% of which drive the economics that we're talking about to overcome the cost of acquisition. If we go to the next page. Super. So one of the recommendations that we have is starting to understand the segments of the population and how they drive value and acquisition. So what you see at the top is the percentage of the churning population. What's probably more important is the share of the value that you can get. And what we've done on the lower side of this chart is start to lay out what do these customers look like on average in terms of what they bring to the bank. So if I look at the paycheck to paycheck customers, they're bringing roughly $5,000 in balances between loans and deposits. And we're getting an outsized share of primary from those customers because they tend to have single relationships. And we're not always getting the loans. They rely, and I apologize, I'm in Maine and the mosquitoes are coming out already as we go through. They're not able to get all of the loans because there's specialty lending in the form of consumer finance and lenders that are capturing some of that share. So banks on the most profitable side of the balances that they can get are kind of losing out to some of these new fintech partners as we go through. As we look across the market into stable mass market, Henry, and affluent, you'll notice that the deposit amounts and the loan amounts are increasing, as are the average value, annual value of those accounts. So obviously, spending an average of $300 in an incentive and an average of $500 in CPA to acquire an account that's worth, or a relationship that's worth $280 to you, is somewhat upside down. You can kind of see that economics will probably not pay off for 3 years on a risk adjusted basis. As we move to the right, the economics say, hey, we might need to spend more money to acquire the Henrys and the affluents because there's more people competing for them, and their expectations of you engaging with them are higher as we go through. And so some of this is trying to figure out which pools are we fishing in and how do we attract those customers that can drive longer term lifetime value.
And Hank, maybe a question to you here is, based on this, would it ever make sense to just stop acquiring mass market or paycheck to paycheck?
The short answer is it depends on your organization. Like any good consultant, we will talk about this as we go forward. But some organizations are very cued to this segment and understand the cost to serve and are able to bring it down. If I look at some of the fintechs, they're specializing in this. I do think that there's other national banks that also specialize in the mass market and how they go to market and how they design products. What we're saying is that with a generalized offer or a generalized product set, you're probably going to end up upside down unless you're able to drive those economics as we move forward. So it's not a bad decision. It's a different business model is what we would say. Great question.
So let's head to our first poll. So which customer acquisition approach is your institution currently prioritizing? Everyone can pick a choice, whether it's account volume, you're trying to get higher value segments, focusing on existing customer deepening, or is it more of a balanced approach, trying to maybe adjust or get outsized proportions of certain segments versus others? And no, it cannot be all four as much as we'd like, or maybe some of your partners would like.
It's interesting that you say that, Olivia. I mean, I think as we work with acquisition, and I think Sarah has the same thing with deepening inside customer bases. What we're finding is the most effective programs are ones that are targeted at a specific strategy and trying to optimize a very specific objective. Trying to do everything is kind of like dinner theater. It's neither at the end of the day.
All right. So it looks like almost half are balanced approach across the board from a segment specific perspective. Okay. We still see a good amount of folks on the account volume aspect. So we're really looking at units. So this is where unit economics are going to come into play even further. There's a good portion heading to focus on deepening. Fewer than I expected, I think, on the higher value segments front. But I assume the larger incentives is the piece that's questionable here. So the economics aspect of this is interesting. So this does tell us that there's a lot of thinking out there already in terms of how do we try to prioritize investment, knowing, Hank, what you just walked through, the billions chasing millions aspect of it. All right. So with that, let's talk about incentives then. Hank.
Absolutely. I think this is one of the scariest things that we talk about with organizations, because everybody is like, the efficacy of incentives and how we design them feels like a really added cost for customers that are likely to open anyway. And I think that, and I'll show you the data that we're seeing that suggests that actually the best investment that most organizations are making in investment or in incentives, where they really have an impact, is both on response rate, but more importantly on that retention rate, because we're incenting activities that really pull through. This research that we just did this year really was eye-opening to me, is how important incentives are for the more affluent segments as we go through. We assume that an average incentive would be pretty good as we go through. And when we're talking about a paycheck to paycheck client who, $300, $250 to $300 is a material change in their cash flow, that is really important. As we get into the affluent segments, the opportunity cost of moving a much more complex relationship versus a $200 or $300 incentive isn't quite there. So we see a couple things as we look at the data. Number one is Henrys, high earners, not rich yet, and the affluent crowd are more likely to require an incentive to consider your organization at the outset. There's enough institutions out there that provide the functional needs that any of these consumers need, that they need something to differentiate at the end of the day. You can create a really cool product set that may be very well differentiated, or you can try to use incentives as a short-term fix or an acquisition fix. The interesting thing is where the over $300 incentives are being applied, you'll see that those are much higher on the Henrys and affluents. That's as much as by design as by requirement. So a lot of organizations have tiered offers that really say, if you bring $5,000, you get $100. If you bring $50,000, you're going to get $1,000 in rough terms. So that's going to forward to the Henrys and the assets. But again, it's really important as we go through. The other interesting thing is, hey, where are we finding these customers? And as you look across the right-hand side, we're not finding them in the same spaces. Television, first of all, is much less prevalent in terms of how people become aware of and consider organizations. And social media is becoming much more important, including, and this is what caught me off guard, the Henrys and the affluents are really on social media and looking at those recommendations. That's a fundamental shift in just my time at Curinos, let alone across my career as we've worked forward. The other piece here is really looking at friends and family. As we look at the P2P crowd, they trust a friend and family. They don't trust people outside their zone. So we need to recognize that, as to where if we get into the affluent and the Henry crowd, they don't trust anything that a friend or family say. They want to go research it on its own. So it's really important to understand how those trade-offs are happening and how we engage those populations. So very, very interesting data. Now, what's really interesting is, as we put this into motion, how do we understand what the impact is? And what you're looking on the left-hand side is, and I'm sorry, this is Hank geeking out a little bit in terms of the data that we've been able to bring together. We look at thousands of variables when we look at acquisition. All we did here is looking at 4 key drivers that each of you control. Number one is whether or not we target for a particular attribute, be it a balanced checking or deposits and loans, whether we're targeting for deposits or whether we're targeting generically as, you know, people who would consider our brand regardless of what they could bring us. Outreach volume is another variable that we can look at, is how many people are we engaging in this? There's kind of law of diminishing returns that we need to be aware of. The other piece is incentive level. Not surprisingly, that has an impact on results. And what I want to try to do as we go through and discuss this is, what are those drivers and how do they play out? The last piece, and it's very important because this is where everybody the 50% of you that said, hey, we need to do both, it is really important. We need to engage customers. Unlike any other industry, financial services, CPA is the least valuable metric in your marketing index. What we're seeing is cost per value, or ROMI, being more valuable, which means really onboarding or acquisition doesn't end until we fully onboarded that customer. And that's where the sale ends. I'm selling the utilization of that solution that we've delivered, not just an account. And that goes far past, you know, the day zero sale as we go through. So what I did for you guys is we created just kind of 4 different scenarios that you could kind of see. Scenario 1 is what I would call BAU, what we really observe most organizations have done in the past. They kind of say, hey, within a trade area around my branches or around those cities that I consider home, if I'm a digital brand, in terms of I'm going to drop mail, or I'm going to reach out through digital or in-home, out-of-home, figure out all the wonderful stuff. But that's kind of the basic solution as we go through. Scenario 2, what we're suggesting is, hey, let's target for balances. Let's start targeting for the value that we really need to receive back. That's the only thing we're changing. And what you can see really quickly is the cost per acquisition is going up because it's a narrower audience and we're having fewer people respond because guess what? There's fewer of them. But as I start to look at the return on marketing investment, which is at the bottom, and I apologize, the boxes kind of got squashed as we moved around here. What we're seeing there is the overall campaign ROMI, return on marketing investment, is at 2.94. So for every dollar that I spend, I'm getting $2.94 back. But more importantly, the value for the incremental or marginal acquisition is also way positive. It's almost 15% ahead of what we would have done without targeting, meaning that mix shift to get customers that can bring balances, loans and deposits, is actually making the return much better for us and the lifetime value much better for us. Go one step further on this, and what we see, thank you, it's like magic, Olivia, as we go through, is let's add an incentive. And in this case, we said, let's just go from $300 to $500 to see if we can improve response and retention in terms of that. And what you see is, yes, the ROMI goes down a little bit on a marginal basis, but the overall retained value of the campaign goes up because I'm getting more customers that would organically open to actually activate those accounts with the incentive because of how I've designed that structure. So again, we're changing the value, not necessarily changing the volume. The last exercise that we did, and I found this really interesting as we start to bring the data together, is we said, what if I can just improve onboarding by 5%? 5% of the people who previously did not activate, I'm able to move through journeys and through experiences that really drive based on their personal needs and preferences. What we're able to do is really drive up that overall campaign response because we're pulling it all the way through both the organically acquired accounts as well as those marginal ones that were stimulated by marketing. So this really tells us that these combination of levers can really have a profound impact on CLV as we move forward. With that said, I'll turn it back to Olivia to.
Let's end this section with the second poll question. How are you targeting? When you think about targeting prospects, what are you using? Are you thinking about the account? Who's actually, who's most likely to open the account? Are you thinking about the initial balance of that particular account? Are you using predictive models to overall, bring in the aspects that Hank talked about in terms of long-term value? Last but not least, are you superseding all of us with employment of AI?
Facebook did just make a big announcement this week, I think, about wading firmly into this territory.
As long as Facebook solves it, then all right. All right. Okay. All right. This makes sense. So it sounds like, at this point, right, it looks like most participants here are really looking at it from a propensity of opening the account perspective, which is interesting, right? When we talked about poll number one, we're trying to balance, by which segment. So quite the most likely, the highest folks with the highest propensity to open the account are going to be folks with slightly lower balances. So really figuring out how to balance that segment view versus propensity. Unfortunately,
Well,
no one's using AI.
I think it's really interesting here, and this goes back to the point that we were talking about before.
Yeah.
Is you get the fish for which you bait the hook. In terms of if I'm baiting the hook for somebody who's going to respond, I'm going to get a responder. If I'm baiting the hook for somebody who's going to bring value, I'm going to get customers that bring value. And that's what that last page was really illustrating, is the more specific we can be on what the outcomes are that we want out of the marketing engagement, be it pre-open, I'll call it pre-opening versus post-opening acquisition, because there's two pieces that we need to solve for. You're going to get better results. You get what you ask for, as we all do. So
it does tell us that the industry as a whole is kind of in transition, right? We're starting to see it going from units to maybe it's balances and product, economics, and really, there's a couple of folks on the line here really around that customer value overall, so the relationship value. It does kind of gives us a little bit of sense.
And
Yeah.
I think that what we're going to see, I think, Olivia, you're bringing up exactly the right point, is if I look at the corollary of how credit cards nationalized in the late 80s and 90s, what happened is a few institutions started to consolidate volume so they had more data so they could run more experiments more rapidly. And it kind of was a flywheel effect, as my colleague Sarah likes to say, in terms of driving more and more success. And so you saw the emergence of the monoline credit card players. We do see that potential as we look at deposits with a few national players having tens of millions of accounts and other organizations having fewer and not quite having the same scale of data or analytics to be able to kind of avoid the adverse selection that could happen as we move forward. And so that's one of the things that we really are concerned about and really want to try to level the playing field.
Right. So that sets us up very nicely for this next part. So billions after millions. We know who's in the churning population. If you're spending that much for these high value potential prospects overall, how are you following the value? Sarah?
It's certainly the $10 million question in acquisition. I think in looking at some of Hank's data on that previous slide, there were some eye-watering marginal cost of acquisition numbers on there. So if I am you know, if we have stacked hands as an institution on a particular kind of design target on the more affluent end of the spectrum, and we have said it's going to potentially cost us more on a CPA basis and a marginal CPA basis to bring those higher value customers in the door, and I get them to open accounts. The thing that when I saw this statistic, it kind of made the hair on the back of my neck as a marketer like stand up, because it telegraphs, I think, almost better than any statistic I've seen out of the reams and reams of fun facts that Curinos has at its disposal, the intensity of the competition and the degree to which we nerdily talk about the delamination of the kind of primary relationship. It's writ large in these statistics right here. In 2019, a mere 5 years ago, right, 6 years ago, only 7% of the switching population, switching primary relationships, had 4+ other checking relationships. Today, that's 50% have a lot of relationships. So obviously the sort of digital first, friction-free ability to sort of open accounts has certainly played into this. And if we look at the next slide, it gets even a little bit scarier from if we are making those big bets on the acquisition side, right? The intensity of the competition for the parts of that relationship that bring the incremental value over the lifetime are even more intensely competed. So as you, on the left-hand side, look at the kind of affluent scale, the number of secondary relationships is significantly higher as you move up the levels of affluence. And then between the sort of primary and secondary relationships, there are a lot of those kind of extra relationships that are peeling off with at least the secondary checking relationship. So the bottom line is, just because you got them, as Hank was saying earlier, to the front door and to open an account is no guarantee that you're going to be able to get that sort of stream of value over time, given the intensity of the competition from fintechs, the ease with which you can move about and change accounts is I think leading to a degree of fragmentation that we haven't seen before. And I think what that means as a marketer is you better have a really good catcher's mitt in place, right? You can't just assume your job is done once the account itself is opened. You really need to figure out, how do we really develop this relationship in a mutually beneficial way? And so if you jump to the next slide, what we're seeing from an impact perspective, kind of on a general overall basis, is that the paybacks, and Hank talked about the economics being upside down a little bit earlier, they are getting pushed farther and farther out. So it used to be kind of 14, 18 months, you'd see a payback on the acquisition investment you made. And on average, that's sort of much farther out. Now, in the first poll question, folks were kind of indicating roughly half are looking to get slightly higher share of more affluent customers. That can certainly have an impact on your overall payback. The greater the concentration of those higher value customers that actually activate and become customers can change this break even. And then the degree to which you are able to develop the mass market customers into truly kind of active primary mass market customers can also change this payback value equation. But if we're just looking at it on averages, kind of the dynamics are, all of this competition is having it's presenting a challenge in terms of your overall payback.
So that leads us to, how are you justifying your marketing investments? Right. So exactly what Sarah said. We used to have a payback period of 18 months on average. If that's getting pushed out from a quality perspective, are you looking at different paybacks now where the first two are repeated, but that's okay? Is it extending payback periods and you're basically just making it so that making sure that you have a payback period within the 4 years? Are you leveraging, the fact that competition has driven up acquisition costs overall, so we need to be able to catch up? What is your challenge in actually trying to get those marketing investment dollars, overall?
Or is it a metric that you're paying close attention to at all? And maybe we'll use the first bullet of the repeated option for the we're not tracking this
We're not
actively.
tracking. Yeah.
I think it's really fascinating as we go through this, because this, I think, is single-handedly probably the riskiest part of traditional financial network institutions and the threats that they really receive. If I look at digital players who've built their franchises around low-cost acquisition and low-cost service, they're more able and adroit at this. As we kind of look at organizations that may have higher costs of acquisition and higher costs of service, the cost of acquisition eventually will outpace kind of their ability to acquire customers. And so the question is what can we do either on on an ad hoc basis, or to create different kinds of value that organizations can find that are not paid media, that aren't doing these things, to try to reduce this cost, is kind of critical. I kind of think back to Xerox. They lost out to Fujitsu because their cost of marketing was greater than what it cost Fujitsu to create a copier. Like, the cost of acquisition was greater than what the other company was building the copier for. Clearly, they're not going to win at the end of the day. So the question is, how are we going to solve that?
So the justification for making increased marketing investments still largely concentrated in share of voice and the sort of competitive CPAs overall, and less focused on the sort of actual payback.
And that, I think this is a question where I'm sure folks on the line, the more and more folks are running into these discussions, I would say healthy and constructive discussions with finance partners and business partners overall, right? So marketers and product folks, business folks, and finance folks are coming together, and they're starting to ask questions in terms of, what is marketing doing from a investment perspective? How should I think about it as a lever? If it's this important, how should we be thinking about measuring? And so it's an interesting, it does tell us exactly what Sarah, you said. If it's about, trying to follow where everyone is going, I think the reality is that most institutions just don't have an unlimited amount of wallet or unlimited amount of dollars to go after. So that will have to transition further as we think about the unit economics.
Yeah.
But that then sets us up, right, for
It
how we
does.
drive
It's
value.
the perfect transition. So let's, take a look at like what typically happens once a customer opens an account, regardless of the individual segment that they may be a part of. What is in place in many institutions today is next best, which is all about kind of what is the next best product that we should recommend to you. And when you layer on top of that the complexities of the kind of P&L structures and the performance that kind of individual product lines need to maintain, what happens is we probably end up losing our focus on the end customer because we're looking for units, right? And what you're seeing on the left is actually a real customer in Phoenix, Arizona, where we tracked all of the communications her primary institution sent over a 365-day period. The size of the bubbles represents frequency, lots of different topics. And, when you zoom out like that, you start to realize, eek, we may just be bombarding rather than actually developing a relationship. This becomes that much more important the more customers are coming in and really primarily interacting in digital only channels. I think you can counteract that with human intermediated interactions, but in digital first interactions, this becomes a really big problem, not least of which because effectively when we look at response curves, which you can see on the right-hand side of the page, we're doing is training our customers to stop paying attention, right? There is an opportunity cost to each of those incremental experiences that we're delivering. Not sure we have a great understanding of the opportunity cost of any one of the pushes that we may be doing. And so the net effect is response rates go down over time. We end up sending more over time, and it's sort of a vicious circle. And you might think that, okay, segmentation is going to solve this problem, right? Because at least we're going to be delivering to the more affluent customers more relevant, more personalized messaging. And that's, that is what segments are designed to do, right? Kind of group similar customers for similarly targeted experiences overall. But if we jump to the next page, kind of what's happening beneath the surface of a segment like mass market or mass affluent is going to tell a slightly different story. Hank mentioned at the top of the conversation, we have behaviors, we have motivations that we really do need to understand. And what you're looking at on this slide is kind of under the hood of a sort of big segment. So on the surface, on the left-hand side, a mass market might be kind of a group that you would develop journeys for, targeted experiences for, targeted messaging and cross-sell for. But when you look at the behaviors within that broad segment, there's actually quite a lot of what we might nerdily call heterogeneity, right? There's a lot of difference behaviorally within that segment. Some in that segment might check their balances pretty obsessively and be very kind of hyper aware of what their cash flow is in any given moment. Others might be very focused on saving for a down payment or carrying significant credit card debt that they're kind of trying to figure out how they get their way out of. So there's a lot of differences in terms of the actual behaviors within that segment. And then within a motivational aspect, right, same thing. You may have folks who are really focused on debt and debt management, others focused on the future and how they can sort of micro save their way into the future, others that are really branch oriented and person oriented and want to interact in a branch first way. And when you think about how to activate in a way that is actually going to develop relationship signal, that's the thing that unlocks that revenue stream. That's the thing that inoculates you from a lot of that competition that's kind of picking away at the relationship over time. It's hard to think about how a message aimed at the mass market could really be personally relevant to such a wide variety of motivations, such a wide variety of behaviors overall. And so if we really do want to capture the opportunity of that LTV once the account is opened, we have to kind of go beyond just the segment level and really think about the specific behavioral elements, the motivations, and the context, the rich context for that customer in order to activate in a way that unlocks a relationship that's rich. And this is one of my favorite pictures of relationship building in data. You can see here the onboarding is really, it's not a linear thing. So we like to think about, okay, well, I'm going to have a mass affluent journey. I'm going to have a mass market journey. And maybe I'll have a Henry journey. Maybe I'll have a paycheck to paycheck journey, but an onboarding sequence of events and experiences that we're sort of orchestrating in order to drive that primary like behavior, get the customer, whatever segment they're in, really transacting and using the account in a way that is going to bring that value through to the institution over time. But relationships are not linear, right? A customer doesn't go from account open to primary in sort of a neat little series of steps. One person might come in and log in 3 times early in the first couple of days, open the app a bunch, and then go dark for weeks at a time. Somebody may click around on some CDs or high yield products, but not open anything for 6 months, right? So the approach we generally take is segmented at a very macro level that doesn't necessarily feel personally relevant when you really think about the behavioral context and the motivational context. And then furthermore, we tend to orchestrate these serial experiences that don't connect with real life and how consumers are actually and members are actually kind of onboarding and determining, do I want this? Do I not?
So with that, poll number 4. How's your data? So I talked a lot, right, about how do we think about personalization? Not everyone's journey is the same. Where is your institution today? And where do you believe it is from a data perspective? Are you using data to can really drive real-time decisions? Are you looking at behavioral data to really just get a sense of kind of what segments exist and then target from that perspective? Are we using demographics? Or the very last choice here, or is it pretty limited? We're still pretty nascent potentially in your data journey.
I think it's Sarah. I mean, I think this is a really interesting question. Is that we see a lot of organizations that are on a data journey, and I think that there's probably, like everything, there's a continuum. We've certainly worked with clients that have spent literally hundreds of millions of dollars building CDPs and data warehouses and things like that, and saying we'll build it and then we'll figure out the use case. And then I think there's and they spent 6 years building it, and then they still don't know what they're going to use it for. Then
everybody's gone that designed the sort of original build, and then all the rocks come in the sort of 3 to 6 year post. Yes, you're right.
And then obviously the other side of this is to be very use case oriented, is trying to develop the data for specific activation and or use cases. Where have you seen the most success as we've done this in terms of both speed to market and value relative to investment?
I mean, I think Customer 360 is certainly something everybody talks about. It's one of those things that feels like it should be a destination, but it's not a destination, right? It is an ever evolving construct. It's a fabric. And so what you build on top of that developing fabric is the critical thing that makes it useful or not. So unequivocally, folks who take a very focused use case first approach tend to go much farther, much faster than folks who are, on a CDP journey and boiling the ocean. 9 times out of 10, we see those, 24 to 36 months after kickoff, still not live, still not in a state where they're driving the value that everybody knows is in that data.
Well, it's interesting too, is that we've also observed different organizations as to who manages the project. And so sometimes we have a highly technical implementation where we have engineers really defining how the process goes forward. And in others, we have kind of business folks that are really focused in on identifying relevant insights that they can activate against. And I think that's one of the things that we've observed is the raw data isn't probably going to be that much signal. It's really around the attributes and the insights that you build off of that raw data that are going to help you kind of get there. And I know, we've spent, the better part of the last 6 years building hundreds of thousands, if not more than that, of attributes to try to find signal. And so it's an interesting challenge. And any thoughts there?
I mean, I think that you're absolutely right, right? It is that's when I use the words customer context, right? That's what I mean. It is the intelligence on the raw data that helps us better understand the human being on the other side of the screen or the glass. And there are an infinite possibility or an infinite set, right? And it's always changing and growing as we have more channels, as we have more kind of digital exhaust coming from more directions. They are that library of kind of algorithms that help us give the customer context are the key to being able to activate well. And you do want a rich and varied set. But you will also, and we'll talk about this in a couple of minutes, need systems that can take in that contextual understanding of a customer and adapt kind of what to put in front of somebody because of what that context is telling the system about where a customer is or a member is.
And just to make this real for our audience, it's one thing to know that my end of month balance is $5,000. That's an interesting fact, and that might be a trigger for something. What's more interesting is that as a percentage of my balance this time last month and this time last year is 5% of what my balance used to be. That might tell me something, which is this balance went down. Or, oh, by the way, I used to have $500 and I've grown it over the last 2 years to $5,000. Two very different trajectories, two very different engagement or contexts that we might want to take action on.
Exactly.
All right. Okay. So not everyone is very nascent, which is great. So everyone's kind of in the midst of moving toward a bit more leveraging data to actually drive personalization, journey building, and prospecting overall, which is great. Which leads us to the second half. And unfortunately, I know we only have 12 minutes. And so we spent a good amount of time on the rest of it. So let's first dive into how we think the science of prospecting needs to shift. Hank, I'm going to hand it off to you to talk about that.
So it's great. I mean, this is a great benefit of the poll that we just gave, right? What we're seeing is people are very focused in on demographics and contextual variables in terms of that. And I want to talk about that as we move into this. First thing that we need to know about targeting is 85% of the purchase decision 10 years ago was based on my proximity to a branch. And so it was very heavily factored into targeting models because that was all that was there. What we're seeing now is the markets are beginning to cleave in another direction based on psychographic variables and preference and behavioral variables, which are what we really need to move to. So one of the things that we need to start understanding is not only where is that consumer, that's important, but also, what are they interested in and why do they buy financial services and how do they manage their financial services? And does that profile work where I can make money as an organization? I need to choose my customers a little bit more selectively based on how I can monetize or create CLV as we go through. So point number one is geographic markets are giving way to psychographic. Geography is still in there, but it's not primary anymore. If we go to the next slide. What we're seeing, and this is behaviorally what we were talking about, we see a lot of demographic targeting, which is helpful. My next door neighbor and I demographically are identical. We're both 55 years old. We both live in the same town. We both make roughly the same amount of money. My next door neighbor has 5 snowmobiles, 2 street bikes, a really nice car, and his house is almost 3 times the size of mine and shadows over ours, which is fine. I have no problem with it. My savings profile, though, looks my savings and loan profile relative to my consumer, the outcome of targeting me is somebody who's more focused on wealth than things in terms of that. And so it fundamentally shifts how I might target inside the neighborhood as we go through. We're bringing some variables as we go through, and what we're seeing is breaking apart the acquisition program to understand very specific attributes. First of all, is this customer one of those 20 million that's in the market right now? Second question, how likely are they to consider me as a brand based on my messages, based on my branch density, based on my share of voice in a particular market, based on my position in that market in a competitive context? Am I a small share player? Am I a heavy share player? All of these factor into a consumer's consideration of your brand. The last two things are very unique to Curinos. And this is where I think we're shifting the tables. This is where we're asking, what is the outcome we want? Deposit quality. How likely is that customer to bring me $10,000 and actually retain that post-campaign? So rather than focusing in on day one production, we're now able to focus in on what is the outcome, the terminal value of that relationship. Second question we ask, what kind of transactor are they? Not a transactor at all. This is going to be a secondary account. Are they a debit active customer that generally will have lower cash flow value? Or are they a payments customer, which tends to use credit card as their primary purchase vehicle, but they're using bill pay and larger transactions, ACH kind of pay bills and things like that, and they have a higher cash flow. Bringing these four things together, we can identify a panoply of audiences based on outcome that different organizations can come after. This is a fundamental shift in how we're thinking about acquisition. Do I want somebody who makes $100,000 and is 35 years old, or do I want somebody who is really targeting growth in terms of their wealth or saving for a business or something like that? Those outcomes are very different than just saying, I want a 35-year-old person who's earning $100,000. Next page. We're getting results. At the end of the day, by focusing on quality, focusing in on incremental response, because that's what drives CPA and the ROMI that we talked about earlier, and focusing in on the end value that I want, we're able to drive improved outcomes as we go through. If you get nothing else from this slide, is you get what you ask for. This is proof of that. Back over to you, Sarah.
The final aspect of this. Okay, so this last piece here, what then approaches are helping banks actually treat customers as, again, not segments, but on an individual basis, like those thousands of lines that Sarah walked through earlier?
Yes. And the short answer here, just aware of time, is there is a layer that we see as a really important layer to put into your tech stack that we're calling decision intelligence. And that decision intelligence layer is essentially a closed loop learning layer that's taking in your raw data, providing that additional layer of intelligence, like what does this mean at an individual customer level, and then telling execution sort of systems, your email, your call center scripting, your CRM banker, I call them stage directions, your web pages, right? What is it that should be surfaced to individuals based on their particular context and understanding? And this, this isn't about ripping and replace, existing systems, but it's about plugging in intelligence in a way that does enable you to wrangle the kind of not human level of complexity that is required for real personalization and relationship building at scale. And if you jump to the next slide, the closed loop learning aspect of decision intelligence really enables you to answer critical questions like, what is the kind of opportunity cost of sending this message? Should we send something now or wait, right? And we've seen, in some of the work that we do, 13% of the time you shouldn't send. And when you don't send for that, it increases the value lift in relative terms by almost 40% for the customers. What are the kinds of messages that are going to build trust and deliver value different for different micro segments? How do we build and balance kind of the individual customer context with the enterprise goals? Should I be optimizing the outcome for incremental deposits or incremental deposits within a particular threshold of cost? And all of those kinds of problems, decision intelligence layer is actually going to help you solve. And on the next slide, we are also getting results. This is an example of a deepening objective for a decision intelligence platform. And we can see that decision intelligence, when deployed, is delivering upwards of 200% improvement versus business as usual marketing, which in this case was being done on a segment basis. So the ability to actually ferret out the individual customer context, the individual constellation of behaviors and potential motivations, and deliver relevant treatments based on that does make a material difference in terms of relationship depth. And then on the last slide, in terms of incremental balances as well. So the bottom line is the kind of best in class players really are starting to lean into this. I would say AI is certainly at the core, this layer of decision intelligence that can enable you to go way beyond a course segment approach to activating and relationship building.
Right. With that, we have a couple minutes left. Sarah, do you want to cover this last slide? The powers of
I would say
learning.
basically the point of that slide was just when you have a closed loop learning, the system gets smarter over time. So in a way, marketers' job with this new kind of layer within tech stacks is to train the system, right? How are you training it to grow over time?
With a couple minutes left, we have 4 big takeaways for you.
Hold on,
One,
Olivia. There's a question. Do you think there is value to create different measures of primacy and other metrics based on segments, or should we skip this and lean on AI to help us create tailored and evolving definitions? Sarah, do you? I'm happy to answer.
Yeah,
But
I mean, my answer would be, I would lean aggressively into AI. I do think that there are lots of flavors of primacy. Now, is some segmented definition of primacy potentially useful as you make your way on that journey to fully AI driven? Absolutely. I think there's a spectrum of primacy that certainly exists, but I would say the best in class players are aggressively moving towards AI defined.
So I think there's 2 pieces to this. On the primacy definition, is that I do think that there's intuition that can help guide or inform AI in terms of where it's making predictions. As an example, when we talked about transaction primacy versus deposit or debit card primacy, as we went through, what we identified is when we let the machine try to figure it out, it found 6 million segments, but they weren't actionable. So it really took adding in that understanding. And so what am I going to do about that as a marketer to narrow those segments to actionable groups? So it's really important to have both of those in there. We do think there's multiple definitions of primacy, and we need to, in order to maintain the client's context effectively so that they consider you, that's really important. So that's point number 1. Point number 2 is you need kind of both in order to be successful. Sorry. Over to you, Olivia.
No, I mean we're at time, but hopefully this was a good discussion, hopefully insightful for everyone. Again, value-based acquisition, you get what you're targeting for. So if you're targeting for value, that's great. If you're only targeting for propensity, you might not get the value you're actually looking for. Looking at being more targeted from a customer mix perspective, making sure they have the right mix of the types of customers, making sure that your job isn't just to get the person through the door. It's about activating the relationship. And overall, as Sarah and Hank, really talked about the decision intelligence aspect of this, and certainly Sarah around decision intelligence, we need to be able to constantly learn and leverage our data to make us smarter so that we can make the right decisions without really us manually having to do that as teams of 60, if you will, going at it.
Hundreds, yes.
All right. With that, Isabella, we'll hand it back to you.
Thank you so much, Olivia, and thank you, Sarah and Hank, as well, for joining us. Super appreciate you guys coming on and speaking to everyone today. Again, thank you to everyone who joined as well. And with that, we must conclude today's program. This session has been recorded and will be available within 1 to 2 business days. On behalf of CBA, again, thank you to all of our speakers and to all of our participants. Have a great afternoon, and you may now disconnect.
Thank
Thank you, everyone.
Bye.